Good morning, everyone, and very much welcome to this session on ESG. We're going to talk about this morning. We've got a very nice, distinguished panel here from the full diversity of the world, as you can see. Traditionally, definitely when we want to talk about ESG, we have to take diversity in mind. Which is a bit of a challenge, of course, these days with COVID, because we've had quite some last-minute changes as well. But I'm really looking forward to actually have a conversation with you for a little over an hour, where we actually can explore together what ESG means, how we're working with it within financial services, and what kind of challenges or opportunities actually might lay ahead. I would like to really first introduce you to the panel, and then definitely we'll start the conversation. But I'd really love you to interact as well. So please feel free to ask questions, or raise topics, because I think the more interactive we make it, probably the nicer it is, the more fun we'll have, and the more we'll learn together. Very briefly, my name is Don Ginsel. I'm founder and CEO of Holland FinTech, the FinTech association and network based out of Amsterdam, covering the Netherlands and partially also Europe. We're very keen always to bring people together to talk about the challenges the financial industry is going through and how innovation can support better financial services for everyone. And in that same context, I think also the people here we have in the panel are very good at that and are all in their own way driving, I think, a similar missions. So I'm very much looking forward to introduce them to you. And always for the sake of making sure that I'm not pronouncing someone's name wrong, I always just want to make sure that I have got my notes there. We'll start with David Suetens at the end. David, can you please introduce yourself and what you do with Sopiad?
Yeah, well, thanks. So name is David Suetens. I'm an independent board member with financial institutions, basically in the asset servicing sphere. That's very much focused, like so many other financial institutions, around ESG. That's the main topic there these days around the table. But I'm also since a year now the chair of the board of Sopiad, and that's a Belgian wealth tech located in Liège. It's a spin-off of the university there, and really providing a client-centric rating tool, but also very much connected to the evolution, and that's also the panel on what's happening in the ESG space of the questionnaires that are coming there on the MiFID space and so on.
Great, thanks. Yeah, let's start with that, and we'll dive in a bit later more. We also have David Lambermont from BeFine.
Good morning, everyone. David Lambermont. I'm practice lead reg reporting within BeFine. What is BeFine doing? We provide advisory and products to financial institutions in the context of financial and prudential reporting. I myself have been working for the past 15 years within banks and investment firms, with finance and risk departments in regulatory transformation projects, implementation of reg reporting tools and things like that.
Great, thank you. And Henri van Tombregen.
Hi everyone, so my name is Henri van Tombregen. I'm the head of product at Greenomy. So Greenomy is a regtech company, a Belgian regtech company that helps financial corporates and non-financial corporates cope with their new, let's say, regulatory burden regarding ESG reporting and sustainability reporting. And so we are a SaaS that truly helps them understand that new legislation and be compliant with the taxonomy. And my role at Greenomy is to really go through those new legislation, understand how they work, and create a platform that is able to answer the needs of anyone impacted, basically.
Great, thanks, Henri. First of all, I'd like the people that are still standing, please have a seat. Might make it more comfortable. It's a long session, so you might wear out otherwise along the way. So I hope you will enjoy it. Maybe first, let's try to do a stock take, right? So I think that we've seen very much an uptake of ESG in financial services, I think across the board, also in all sectors. But maybe just to get an understanding of where we currently stand, I think I'd like to start with you, Henri. I think Europe is trying to take a leading position in setting the standard on how we deal with ESG. And that's, I think, what you specialize in with Greenomy as well. So can you tell a little bit about what's happening there?
Yeah, sure. So the European Union came up with a new legislation, and the idea is to have the same standard to evaluate how sustainable any company is. So taxonomy is at the same time a classification of economic activity that may have a substantial contribution to an environmental objective. So there are 6 of them. And it's also a methodology that states for each of those activity and environmental objective what are precise criteria and threshold to be met in order to be able to claim that the activity you performed is performed in a sustainable way. Now the interesting idea with it is that it will become the common language between the financial and non-financial world, as banks, investor, asset manager will use the score, so there's a taxonomy score of the corporates, to evaluate what is the part of their investment, of their lending activity, that are directed towards sustainable activity. And so we finally have, let's say, a methodology that is transparent, comparable, and that aims to really bring down greenwashing opportunity to a minimum, because now everyone will know exactly how it's measured, and there is no black box anymore. So we have something common to the whole market, and that's also the interesting part, is that it's becoming mandatory. So for now, it applies to large listed corporate and basically large financial institution. But in 3 years from now, this will apply to any listed company and large private group. So it will really have a massive scope, which hopefully will truly help investors and lenders to identify truly, this time, sustainable activity and reallocate capital. So that's really the idea behind the taxonomy, is to reallocate capital toward really sustainable opportunity in order to meet their goal of a decarbonized economy by 2050.
Okay. And so is the legislation already done? I think we still have parts to come, right?
So basically it's an evolving framework. So it starts in January 2022, so in a month, although it's a limited assessment. But so there is 2 environmental objectives that are already fully defined, meaning that they are criteria for all of the activity that may contribute to them. And there are 4 remaining that will come by the end of this year or the beginning of the next, and that will be, then you can report on them for the next taxonomy report. And the idea of a taxonomy is that it's a moving tool, so it's also called a transition tool that will help corporate step by step meet the expectation of 2050. And so it will evolve every 3 years. The criteria will be updated and will be more strict. A new activity may be included in as eligible, so having criteria. And so yes, it is evolving. But for now, it will actually, the first report are due in a month.
Okay.
Yeah, exactly.
No, so I want to ask you as well, David, if you look at sort of the way that regulators are looking onto this and what kind of requirements they're now putting forward directly towards companies to report on, do you see a change directly? So do you see now the companies you work with actually incorporating this into their standard of reporting? And do you see also a pull side on the regulatory side there as well?
Well, yeah, obviously, because there is a regulatory requirement to do so. So when we look at the EU plan of financing sustainable growth, so the taxonomy regulation is one element of that plan. So defining, okay, what is sustainable? How do you have a coherent definition that everybody is using? So that's one element of that plan. The second element is also something that's going to be evolving through mandates, through guidelines, through supervisory expectations published by the ECB in the coming years, but already some have been published over the last year and a half, is how to integrate that sustainability aspect into the prudential requirements of banks or financial institutions, more broadly speaking. So that's a second element of that larger plan, I would say issued or communicated by the EU institutions some months ago.
And how do you see that institutions are coping now with these new requirements? Are they? Is it easy for them to make use of to do the reporting, or are they still also struggling to set it up?
Well, reporting is one thing. So you have multiple aspects. Reporting is a very tangible aspect, obviously, that is going to pick up gradually as from next year in the form of Pillar 3 disclosures. So Pillar 3 disclosures are what? That's the risk disclosures that are publicly available to to the public
Yep.
and published by banks. That's one pillar. You have other pillars such as Pillar 2 and Pillar 1, which are not publicly disclosed. And so the impact of sustainability into the prudential requirements is more broad than just reporting. Reporting is one aspect of it, but you also have a lot of supervisory expectations in terms of how to include ESG, or more particularly environmental and climate risk, into your risk management framework, into your governance, into your different supervisory bodies within your institution. So there's a lot to do indeed. But one of the first thing to think about is what Henri mentioned, being the data.
Yep.
So in order to improve something or to observe something, you need to be able to measure it. And the timeline of implementation for financial institutions is parallel to what is happening for corporates under taxonomy.
Yep.
So banks need to have the data that will be published in the context of taxonomy regulation in order to know, okay, for our counterparties, our portfolio, that is the data we are now going to work with.
Okay. Yeah, I think that's in any case quite nice to see how they're picking this up and how these. So you see that there's a slight difference, you say, in the way that the financial industry is picking this up compared to other industries, as the regulators are more on top of that, probably. But so, do you see that it's well aligned with how other industries are picking it up?
Well, it's true that for financial institutions, the impact is less direct, in the sense that for corporates, you will have a direct impact on supply chain, on the produce that you buy in order to produce your goods, things like that. Mm-hmm. For banks, it's more indirect. It's more measuring. There are ESG risks are classified as you have physical risk and transition risk, so you need to be able to measure for your counterparties, whether it's investment in bonds or mortgages, things like that. Mm-hmm. You need to be able to measure that risk, but it's more of an indirect impact.
Okay. Yeah.
Indeed.
Clear. So I think maybe David, on your end. So I think you witness how people in the boardroom are talking about this. How do you see our organizations? How are they embracing this? What kind of transition is going on in the discussions?
It's very good question, because I think certain institutions are really approaching it, from my perspective, wrongly, and saying, okay, this is just another regulatory hurdle we need to meet. And then, yes, there's a lot to do on the reporting and the data, and that's crucial to get right. But in the long term, for your institution, you're going to fail, in my opinion, my personal opinion, and that's why I'm passionately connected to this ESG topic, if you don't address what David was alluding to, also your strategy and so on. So I think you need to have the courage as a board to revisit your strategy and say, in this new world, how are we going to embed ESG there? Not only for us as an institution, do we have solar cells on our roofs, our windows of our buildings, and so on. Our supply chain as a financial institution, which is far more simple in general compared to other industries, but also what's our role as an intermediary, where we finance, and that could be loans, that could be in private banking activity, whatever, in your activities as an institution, where you interact with your end customer. How are we motivating these customers to become green as well? Because that's the good thing about Paris, the Paris Agreement, and I'm not referring there to Glasgow, but especially Paris. Paris really recognized there is a role to play for us as a business in this transition towards ESG. Before it was kind of governance will do it on their own. Paris really recognized you, the business, have a seat as well, and we're counting on you to deliver as well. And I think one of the best quotes I ever saw was from Morgan Stanley. If there's no human race anymore, there are no banks anymore needed. So we better get involved with the topic. The planet will survive in one way or the way. The planet will adapt. The humans, that's a different thing.
Yeah, No, I think that's a fair point indeed. But sometimes a lot of organizations struggle with that very long-term perspective, right? So I think especially listed companies are very much driven by the short-term cycle of showing performance and drive. And from that angle, I think that let's say the real impact of not being sustainable, not being social, is still very much in the space of either regulatory requirements that you're not meeting and you're being fined for, or reputational risks.
Correct.
Right? So I think that's very often where I see that those are still sort of the main drivers, where people can at least make it tangible for their short-term perspective. But how do we make the next step towards a sort of a real long-term embracing and also maybe helping to tell the story, right? Because I think it sounds very appealing the way that Morgan Stanley puts it, but for a lot of consumers, that's just too big of a concept. Any thoughts on that?
In that direction?
No, there is definitely evolution. So I think, and that's maybe also connected with the point you made on and David, is on one part there are really specific regulations that both of you addressed, I would say, and that needs to be met. But don't forget, there's also the ESG topic gets a lot woven into other regulations as well that apply. And that's kind of different of the other regulatory trends we saw in the past years, where it was really, this is on liquidity what you need to do. This is what you need to do on credit. This is what you need to do on capital. It was kind of locatable, if I can, or doable when you rolled up your sleeves. Here it's much more, there are specific regulations related to it, but there are also, it gets woven into a lot of other regulations as well. Yeah, existing regulations.
That's exactly how the ECB puts it, right? Yeah. So that you have your existing risk, like you say, credit, liquidity, market, operational risk. ECG is not a new risk. It's something you need to be able to determine how it impacts your existing risks. So, for instance, a very standard example would be for a bank in terms of credit risk. How can flooding risk impact the collateral of your mortgages, things like that. So that's a direct impact on credit risk. Market risk can be, we have a position in, Shell bonds or BHP Billiton bonds, but there is a risk, so a transition risk, that market sentiment, supply and demand will evolve, and those companies will potentially suffer more. And this will have a direct consequence on the asset valuation of instruments issued by those companies. Yep. So that's a direct impact on market risk. And indeed, that's the big difference of ESG is not a new, column.
Just for me to understand as well, right? So do you see that as, because generally, let's say, for example, the risk of climate change happens regardless of any ESG policy. Right, so it's not per se related. So you have your conduct, the way that you want to conduct your business. That's ESG driven. But for the rest, you have an impact that's kind of regardless of that you might have to swallow anyway. Like climate change, for example, that might be coming regardless of your policy to do good. Do you see that is that being seen as one thing generally in the way that companies look at that, or are those separate? I'm just trying to figure out as well, sort of how we're having those discussions.
Well, there's a difference of an existing risk that we know is somewhere, and actually being able to measure it and take it into account into your risk management framework. Yep. That's what the supervisor expects. The supervisor doesn't expect you to stop flooding. It expects you to be able to know that your office in Luxembourg or your office in Verviers is subject to physical risk, and that you prepare yourself to that by reserving capital or identifying.
Exactly. But do they do that from an ESG framework perspective? Or would they do this anyway? That's more sort of, whether it's actually part of the ESG subject, that's more what I'm looking for here.
I would say yes and no.
Okay. I think by the taxonomy is kind of pushed on them, so they don't really, they still have the possibility to not do it, but then it will truly impact them. But it's taken into account that if you want to do good, there is multiple ways to do it. So as you say, you may try to reduce your impact on the existing risk that will still be there at least for the current year. But there is also a way to adapt what you already do today compared to that risk to be sure that you are less prone and that you will be less impacted by climate change risk, for instance, which is called adaptation. And that will help you secure your business and have a more perenne business, which is another way to go about it. But I don't think it is part of the ESG framework, let's say, but it will become more and more mandatory. And at that point, corporates would start to integrate that in their, let's say, day-to-day strategy, because I think ESG, in a way, will stop to be like a separate topic. As you were saying, it's more and more impacting different impact. When you have a taxonomy score, for instance, you don't have a threshold to reach. The taxonomy doesn't say you need to be 70% aligned and then you're good. It's just that you evaluate your sustainability, and then that will have impact on the way you raise capital, at what cost, the way you can take a loan, at what rate, etc. So it will have multiple indirect or direct impact. And I think that more and more corporates will incorporate their ESG strategy within their commercial strategy as well. So it will stop being separated, and I hope they will do it. That's really, I think, where we can benefit the most. But if you start integrating the two strategy and stop having a specific regulatory or ESG strategy and your own commercial strategy, and you merge the two, that's where you can really both make money and have an impact.
Yeah, and then you come to the strategy point as well that David was making, right? So it needs to be embedded in your purpose and strategy completely. Yeah.
And explore, I think, and with the board, really in the strategy, what are also the business opportunities? So I've been for a very long part of my life part of the second line as risk manager, but then last year's was first line. And that's the more tricky debate to have at board level. I think at board level the risk side and the reporting side goes well. They say, okay, we need to do that, all the regulation. They have the discussions on the different risks and how it will impact them. What's more challenging is, okay, what are the true business opportunities here? And you were alluding to it. Do we need to, before, I mean, let's give two examples. A typical example in Belgium could be, do we still provide 30-year mortgages to apartments in Knokke when we know Knokke is getting flooded? Question mark.
If it's high.
I could use Scheveningen as well. It depends how high it is and so on.
In the Netherlands we don't have flooding.
But you could have examples like that, and these are more the questions to be asked on the business side, I would say, and that can be product by product, sector by sector, country by country. That depends. Maybe another example could be, hey, maybe in the past the corporate loan to Shell was a no-brainer. It was a no-brainer. And probably they got a rate below market rates. Definitely, they got, because they had their rating and so on. Maybe in the new world, it's a company in plain transition. I think it's part of the financial industry to, I mean, that depends on your strategy, but to also finance industries that are maybe not dark brown, but light brown, and to help them transitioning to green. But maybe it comes at a different price compared to 20 years ago when Shell was the holy grail.
But this is an interesting point as well, right? I think because we see actually quite some different approaches here. So you see the investors or financiers that basically say, you know, we back out of, you know, any industry that's currently polluting. And you have the other ones that say, you know, no, we want to stay in because we want to make the change happen. And we want to stay in conversation to and so these two sides, they're kind of conflicting. How do you see that debate going?
I see very much the exclusion as very much the old world.
Okay.
I mean, clearly you need to do exclusion for, well, certain countries, certain segments. Then you enter also a bit the compliance domain. And you need to exclude certain, and that's mandated by law, etc. But I think if it's, you need, next to your credit analytics, you need to make an assessment, where is that company going in this transition? And is it really making a true effort to become a sustainable company?
I don't think it's conflictual. I mean, it's taking into account ESG in a broader context, and the answer is not black or white. The answer is not no more lending to that sector, or It can also be like
you see sometimes you see them. For example, there were a couple of pension funds that said, we'll go out of oil and gas. Period.
Yeah.
Right.
Yes,
So
that's one possible answer.
Yeah, exactly. Yeah.
Another example is mortgages that are priced differently.
The example you give is Norges. And Norges is the pension fund of the Norwegian state, and they said, we get out of oil. On the other end, the whole thing why that pension fund exists is because of the oil income.
Exactly. No, but for example, also in the Netherlands, a couple of funds actually did that, right? So for example, the largest pension fund from the civil servants actually said, we'll drop oil and gas, period. Which is pretty serious money that basically gets pulled out of an industry, and they're not at the table anymore. So I'm just curious as well, because I think it makes a clear statement, but at the same time, the transition needs to be financed as well, right? So I think that's...
Exactly, I think it's very important, and you were saying it, the transition is key. So you don't need to punish certain segments that are, for now, carbon intensive, if they are alternative or if they are, let's say, best practices in place, and truly best practices. Not sometimes it was, in my industry I'm the best, but it's still enough. But sometimes there really are new innovative technology that allows to do the same as before, to produce the same good, but in much less carbon intensive way. And I think that's really where we should push the investment, so that industry as a whole can transition and produce what it was producing in a much more effective way. And that's where you should put even more emphasis, because that's where it needs to move. There is already some sectors that are, let's say, green or truly sustainable, and that's great, it's already set, but I think where the money should go and should really help is to help the other one transition. Because some industries, they won't disappear. They are here. I mean, in cement, you will probably have cement for a long time, but there are alternatives now that are able to provide cement in a much more harmful way. And if you were promoting those solutions, you may generalize it in the market and still have better solutions to come in the future.
No, I think so too. I think from that perspective, it's really important that we make it. But it's complicated, right? Because I think there you see that very often. I think a lot of debates is driven by reputation risk, right? So if my brand is associated with that activity, that's what I want to avoid, because that's being seen as very sensitive. And that's why sometimes they make these harsh choices, which at the surface, in any case, are easier to make than to actually stay at the table and fight for, we believe in their story. We believe that they're heading in the right direction. It's sometimes complicated as well. So I think, do we know well enough already, or is it also something we need to evolve on how we tell that story and how we have the discussion with each other? Because sometimes it's really harsh in the way that it's also we talk about this, right? It's either good or bad, rather than the gray area, especially in public debate.
I think, the way to answer it, I would say, is also you need new talent in the financial services industry, because, to your point, and the cement factory is a great one. Before, how would you look at that file? You would look at it from a balance sheet, their cost perspective, their EBITDA, their capex, etc. That's no longer enough. You need to look now how they're changing. Are they using, and so you may need a bioengineer in your team or whomever, or a chemical engineer to assess those processes and whether they're truly transforming them to green. I'm a lawyer by training, a lawyer or economist, and I don't want to offend anybody, can't do that. So you will need much deeper knowledge also on the bank side or on the financial services industry to really assess truly their production, their supply chain, etc.
It's become integrated then. It's really not separated anymore. It's really become integrated, as the same decision making will be based on multiple aspects, including financial and, let's say, ESG.
Yeah,
that's also a very practical supervisory expectation, by the way, that it needs to be included in your credit origination process. Yeah. It's written black and white.
Exactly. Yeah. And so I think it was mentioned also that we really need a lot of data to actually be able to do this, right? And I think that's also the revolution that we've been going through, is I think that there's a much stronger transparency of value chains. We have much more global data sets that could actually, you can actually tell what 20 layers down in your supply chain is going on, while before it was all very hidden deep down. Do we have enough data and can we cope with it?
Not yet.
I think that's where I'm involved, let's say, because for now, as you know, for the taxonomy, you need a lot of data. It's quite granular, so it's not at the company level. It's in the activity it performs, so it can be done to the, let's say, manufacturing plant of the company. So it's very specific. And no, the data does not exist yet because they don't have yet to report on it, or it exists in part and pieces, and it needs to be, the corporates needs to change the way they collect their data, or they take into account their data in order to produce their taxonomy assessment, or to support the industry with the necessary data. That's where I think that digitalization of those tools, helping corporate do it in a way that is more automated, because they already have the IT infrastructure, they capture already some of the data, they just need structuration in order to make it as seamless as possible, let's say, will truly help. But it's still, that's obviously a work in progress. That's where we try to help, really, because if you don't have the data, you can have the best analytical tool, you can have the best regulation. If you don't have the data of the highest quality, it doesn't matter. And
will this drive then also a wave of reporting through the value chains of the large corporations? So let's say the large corporations that are now falling under the regime, right? The smaller ones aren't yet, but I can imagine that the obligations of the large one will push down through their value chain towards small ones.
Yeah, exactly. There's a pressure, let's say, an indirect pressure So basically, for now, like you say, it's large listed corporate. So it's not the SMEs. It will include the SMEs in the future, but just listed one. So it still leave out millions of, because the backbone of the European industry are SMEs. They are the huge chunk. But there is a strong indirect, let's say, pressure or incentivization for those companies to actually do the exercise, because they will be more attractive for the financial industry, because they would have the data.
But I think let's say from an institutional perspective, they have to, right? Because you need to know about your employees. It's not you'd like to know about your suppliers, you need to. So they will be forced. So it's just like when you want to work with a bank, you need to comply with the standards that banks need to work with, right?
Yeah, so exactly, but then you need to set the standard. Because for now we have a lot of different ESG scoring system. There's many on the market. So a small company may do one and state, okay, I'm sustainable in that way. But if others don't use the same, it's really creating a mess. So that's why I think that standardization is a good way to go and be sure that data is usable, basically.
You recognize that as well?
Yeah, it's indeed in order. You need a couple of things. You need, in order to report something, you need, first of all, definitions. So that's not there in taxonomy. Then you need data that will come with NFRD. And then you need tools in order to be able to aggregate that data, which is also a supervisory expectation. So you need to be able to aggregate your risk data in a timely manner. So recognize the wording of BCBS 239. Now ESG has the same, I would say, requirements. What is very important for banks is not to treat ESG data, I would say, separately, as in parallel as what already exists in terms of data quality governance, data quality frameworks, etc. Because over the past years, all banks, large banks with BCBS 239. In Belgium, you had a data quality circular back in 2017, meaning that the banks that I know in Belgium, they all have a data quality governance framework in place. Yep. And what will be very important for tools such as Greenomy is how they fit in and how they integrate within that data quality framework that already exists. And that it doesn't start something on the side that would not be captured by that governance process on data that is currently there in financial institutions. Yep. That will be one of the key elements, I think.
Yeah, yeah, definitely. I think it's. I hear a lot of talk about this in a lot of financial institutions now, especially investors that all need to look at. Okay, first of all, we need the data, but second of all, how do we validate the data to be sure that we can rely on it? Because that's the second one. Yeah, David.
And I think there's one dimension more. So that's really the output and how an institution reports on it. But there's also listening to your client, the end customer. Ultimately, before I gave examples like Shell and so on, which are big corporate clients, but you could also look at let's say, your retail client or your private banking client, and how do you understand their ESG preferences, which is also coming up, that's embedded in MiFID. So the revision of MiFID applicable from August next year. And how do you combine the product output, I say, or through taxonomy, the ESG products that are being delivered, et cetera, by asset managers, with the ESG preferences of the client, and how do you bridge those two as well? And that's where you're also going to discover the business opportunities.
Yeah. But do you feel that that's is it close by? Because I think still we're seeing that let's say quite a bit of a division in society. I would say that, you know, I think it's sort of aligned with what Piketty already started writing a couple of years back. There's this divide going on between the haves and the have-not increasingly, and you see that across all kinds of divides within either Brexit or politics, but I think also with regard to sustainability and ESG, whether you can actually play along and, you know, live up to the modern standards, or whether you're more like a sitting duck, feeling that you're not allowed to do a lot of things anymore, right? So that's you have these different perspectives that are pretty hard sometimes to reconcile.
I think there's a recent study published by Nordea Asset Management. I'm hearing a different sound here in my ear, but. Or somewhere. Anyway, a Twitter.
It's a whisperer.
And what was interesting about that study is that it said that financial advisors, let's say a private banker or the one who interacts with the end client, they had roughly 2 years ago, 30% of their discussions were already tilted around ESG. It only has gone up by 5-6% in this year. So not a lot. So to your point, there's still roughly 60% there to have that dialogue with the end client, which is partly an education also of, hey, do you still want this kind of funds that are maybe ugly funds in your portfolio, or are you going to tilt differently? And the good thing is, thanks to these gentlemen, the transparency is coming. But my message is also, we need to hear also what the end client wants, and that's going to be forced on the industry by MiFID.
Yeah, but putting it in MiFID indeed, so I guess it's like an extended questionnaire.
Yeah, exactly.
At least it's, again, an example of how the supervisor or the political world, broadly speaking, can move up certain things that existed already a little bit, but at least once it's embedded in a supervisory expectation or in a law, well, it forces you to actually do it. But I would be surprised to see what would come out of these questionnaires. Because now, ask any retail investor, they would say, yeah, sure, I would prefer ESG.
Yeah, but so I think there it's really an enrichment of the suitability.
Yeah.
And that should lead, hopefully, to a better dialogue with the end customer and getting more ESG products in the portfolio. It should
also change because of the taxonomy, right? Because
exactly.
I think until now, you either had ESG-driven funds and the rest, right? And it was only a small portion. And what you now want to do is actually, I want to look at all my investments and see at least how they do on ESG.
Exactly.
And that's a transition, right?
Yeah. And there's a distinction between, do I have ESG characteristic, meaning I am somehow taking attention to those ESG, or is it my goal? And so you bring a needed distinction between less Manichaean world. It's not I'm bad or I'm green. It's more okay. There is no let's say a scope on which I can be, which is great. I think it. And as you said, I think one thing very important is, let's say, the teaching is not the right word, but if you have a transparent methodology, it's great. I think for me, it's one of the most important things because you can communicate. But if on the other hand you don't educate the end client on what exactly that methodology does, what is computed, well, it loses a bit of its power. So I think there's also a need for the end client to find new ways to understand how that new framework works. And I think that's where we could play a role as well, and the industry can play a role by teaching their client or giving them nice insight. And I think it's already going in the right direction. I keep seeing big firm launching really small and well done, let's say, pamphlet that summarize thousands of pages of legislation. Obviously, it's not super precise, but it just gives the right idea behind it, and it's easier then to understand how it works.
Who reads the regulation anyway?
Well, I had to.
But I think the challenge there is indeed, because I think the retail investor is still relatively sophisticated and has a certain interest into this. But if we actually look at the consumers that actually are in the supermarket or anywhere else picking up products, and you know, how do we actually talk to them in the end when they, you know, pick up a package of something and want to understand more about what's behind all this? Because the risk is that it might be too complicated still where we stand, right? And sometimes you could also oversimplify it, because just putting like carbon emissions on it is also maybe not cutting it. So I think there we have quite some learnings to do still also from a communication perspective, also as an industry, to make that more clear.
But a bit like in the food industry, there is the emergence now of labeling agencies. So given there is, and that's why the taxonomy is so important. By the way, it's awful to call that taxonomy because everybody thinks about tax. But the good thing about the Wikipedia or the definition book is that as a result you can start now, and that's one, you have a Belgian one, you have a Luxembourg one, you have labeling agencies who start to give, a bit like you refer to the supermarket. If you look on the can, often there is a label of an agency that says it's sustainable. Unfortunately for financial services, it's not yet going to be an EU label. It's still very national, but at least it's a form. 3 years ago, we couldn't dream of those labels because the definition set was simply not there.
No, and that's also, of course, interesting. Of course, we very often talk about a change to come, but actually a lot has changed already in the meanwhile. Rick, you have a question?
Yeah.
But you can use the mic beside you. Yeah. Can we get the mic on?
Better.
Yeah, try again. Should work now. Yep.
I thought because small room, maybe I could just say it. But I would like to comment on the issue that very often these products are too complex for the average Joe. I think the same is true for investment products today. And as long as we don't, as an industry, go too deep in explaining everything that's behind, consumers will follow. I remember a story of my mom who was suggested robo-advisory instead of advice in the office, which was more expensive. But the main reason why she chose for robo-investing is because she doesn't have to go stressed 2 times a year to the bank office, because, again, she has to choose between 2 products she doesn't understand.
Yeah.
If those 2 products would have a label, sustainable 8 on a scale on 10, for example, and the other one 5, it would reduce the stress simply because there's a very easy comparison explaining how much better Fund A is compared to Fund B for the future of our children and our grandchildren and the generations to come. So I think we can easily fix this if you can make it simple in explaining what the contributions are of the investments they make.
Yep, it's still quite a challenge. Yeah, please hand over the mic. It's still quite a challenge, actually, I think, to do that in an honest way, because these ratings also tend to be prone to fraud or greenwashing or oversimplifying sometimes the choices that you have. Right. So, good point. Thanks. Yeah, go ahead.
Yeah. I was listening, and sorry that I only came in late, so maybe the point has been discussed already, but what I'm missing in the discussion here is, it is nice that Europe said we're going to go to the moon. I mean, I think we should all be proud that Europe put that stake in the ground, that we will have 2030, 2050, Green Deal, brilliant. But I think the way to go there is a little bit dodgy, because you talk about it's nice to have a label, it's nice to have a decision, but actually what you do, and I think if we take back MiFID just a little bit and we say this is to protect the end investor and to bring transparency, but now you're going to force the client, as of the 2nd of August, you're going to force the client to make a decision how much they want to invest in sustainable and ecologic sustainable assets. But the point is, as soon as they put this to 20%, there are no products in the market. Put that to 30, there's no product in the market. If you put to 100, you get an Article 9. That means that you have 100% objective to be sustainable within the taxonomy, 100%. If one company that is in there has one activity that is no longer 100%, it moves to Article 8. So you have not a lot of them. I think investigations recently, Morningstar said it was only 3% of all the funds today is Article 9. At the same time that Article 8 is such a wide container that suddenly everything becomes ecological. So I think we have still a bridge to bring back together, because now it is complex for the end customer. And I actually wonder if we really are doing something good in terms of the MiFID spirit.
But so do you believe that that's basically, do you think that these definitions are either not clear enough or too wide, or do you say we just lack the investment products at the moment and we need to see a transition there in the adaptation?
It's twofold. Okay. The definitions are not clear and they are mismatching between SFDR and taxonomy. So you cannot bring them together. So let alone that a retail customer, the grandmother or the mother from Rick, if she has an idea that what's the difference between sustainability and ecologic sustainability, it's the same thing. It's not. So that's a bit of complexity that comes. And then if you would take the new way of looking at it and you bring that to the current offering in terms of funds, because that's where it's easy being calculated, then there's not that many that really have good scores. And you mentioned, David, you mentioned Nordea. I think that the Nordics were the first area that really said, we're going to just come out with it. And if you're going to put the slider up, you'll see 3%, that's the maximum we can give you. Mm-hmm. But it's a very hard message. Yep. And I think that's where we have to be cautious, that we use the right communication and education skills.
But I think the answer is, for me, in the taxonomy, is that vocabulary has now just started. And it's going to continue to evolve. So it's going to be, that language is going to become more refined. And as a result, given that language becomes more refined, the resulting products will become more refined as well. Yep. And that's how I see the connectivity.
I do agree with you that there is really a mismatch between the taxonomy and SFDR, so the taxonomy for fund. For now, I agree it's a bit of a mess, and the definition weirdly, on that side, are much less clear-cut and much less usable as for now. It will evolve, okay? So those frameworks are able to get better, and I really hope that they will clarify some aspect. But now, and I think I join you, David, is that the taxonomy, the aim of the taxonomy, even if for now, for the first exercise, maybe not many companies are 100% aligned, that's for sure, because they don't have yet the processes in place to get better. But now they have. It's not only a tool to measure how sustainable you are, it's also a rule book that brings you information on what do I need to implement in order to be truly sustainable, to improve myself. And so in 2-3 years, we might have many more prospects that have integrated those aspects and that are now, let's say, enlarging the pool of sustainable investment. And that's exactly the goal behind the taxonomy, is to help identify truly sustainable prospect, grow that pool so that the, let's say, true investor in a sustainable opportunity are not limited anymore to those 1%, and that basically you can't do much about it.
I buy it 100% because that's where we fly to the moon. That's the nice thing. But we already flying to the moon the 2nd of August next year. Yeah. And that's very, very soon for end customers to make decisions. That's a bit my point.
There's no transition?
It's an industry, well, first of all, it's an industry in transition. It's an industry where, and Rick alluded to it, is where traditionally, even after the global financial crisis, we continue to, here, buy this product, here. Your mother, buy this product, sign here. It's a good financial product for you. And we had lovely scandals in Belgium about that, which are still in court. And in Holland as well, and in Hong Kong as well, everywhere it happened. And this industry is now slowly getting to grips, although they've said it for many years, on how to listen better to the customer. And what are really the preferences, but that's why we need to get the language right, to your point, Koen, and enough refined. What is really what the customer wants? What are their preferences? The MiFID first questionnaires were still very high level. It led to, what was it, on average 5 profiles with banks. I think with the ESG embedded in there, it will become slowly but surely more refined. But even there, it's not going to be fixed on that famous August date.
Thanks, Koen. Thanks, others. Yeah, go ahead. Please grab the mic.
Hello.
Yeah.
I also think that there are slightly, and there might be a contradiction when we talk about MiFID and ESG, because MiFID was indeed conceived to protect the customer, has a bit of negative insight in your customer or investment of offer to your customers. But I do think that the sustainability is more like a positive offer.
Yeah.
How do I, as a customer, want to make a choice to be invested or even have payments that are going in the right direction? I pay maybe less for a certain product and more for another product. I'm just thinking out loud. So I have a bit of problem in why has the regulator chosen MiFID to seize the information about sustainability? Because I do think you have a bit two concepts on protecting the customer on the one hand and stimulating the customer to choose for a sustainable investment on the other hand. And I have a problem with that from a conceptual point of view. Let's see how it will be rolled out in the industry. I do agree, Koen, 2nd of August, it will be a lovely challenge, because if we've seen MiFID 1, it has taken 2 years. MiFID 2, it has taken 2 years. So in reality, it will take 2 years again. Yeah. But that's not a problem. I think the path is clear, and that is more important. But still, the point I wanted to make is MiFID the right tool to push banks towards more sustainable proposals to the customers? That's a bit my conceptual thinking point I wanted to make.
Any comments here on that?
Well, maybe I put a question back about which would be the other tool they have to stimulate that conversation between the financial institution, the advisor, and the end client. I think it's the only tool they have in their toolbox.
Well, if we gather information from customers, and I'm talking about retail customers today, but it could be applicable to corporates also. You have the AML package, where you ask a lot of questions. Yeah. You have MiFID when it comes down to investment. Maybe we should create a third pillar, AML, MiFID, ESG, because you get information from customers and you do it at one point in time of the relationship. Yeah. Maybe. I see, Eric, I see you like that. There are not a lot of opportunities to get the information from the customer, and maybe MiFID is an easy one. We have already something over there. It's easy to capture the information, but we might involve maybe and go further and carve it out from MiFID, but I'm talking about 2, 3, 5 years, and carve it out from MiFID and have a dedicated, sustainable questionnaire, whatever, from a customer. That's maybe one of the next steps.
The fact that it's embedded in the regulation does not mean you can take the picture separately on ESG as an institution. You can say, okay, that's suitable MiFID-wise, but if I look at your ESG preferences, that's where you end a bit more up and then bring it together in the product offering. It doesn't mean because it's in the regulation together that you can't, you still need to assess it as an institution, but handle it differently in the interaction with the client.
Yeah, go ahead. Yeah. Always nice to get more questions. Bring it on.
So we talked a lot about gathering the data, about making a choice for ESG. But what is your belief? Because in the end, an investment looks at risk and return. If climate risk and all these risks find their way into the PDs and credit risk or in the liquidity spreads, then you will pay a high price for something with huge risk as well. So the return will be very low for the risks you're taking. So if we push people like financial services into this model by pricing for those risks, then this will automatically transition, in my view, into people going more for sustainable kind of products, because the return on investment will be higher for lower risk. And that's for me then the key towards pushing the bigger public, because in the end, what matters for a lot of people is what they have in their portfolio. Yes, you have funds that institutionals that really will look at all the elements. But a lot of, let's say, normal investments, if they go further than the pre-phase in an investor's book, they're not going to go any further. As people that just invest as a hobby, they're not going to look at all the numbers. I remember if you look at a financial statement of a recent bank, it's like 450 pages. No one reads that. So they have to. Don't get me wrong, but no one reads that. So The point is then to make the difference in the pricing and risk and return, in my view. I don't know what the view is of the panel, but that's how I see the transition towards ESG much more solid, because it's.
No, so I recognize that. I think we briefly touched upon that also before we started the session on sort of, let's say, that in the end, the driver needs to be really measurable and preferably financial, right? So that actually it actually is, the impact is not just something virtual, like, okay, really nice to be good for the planet, but it should actually hurt if you don't. And that's where indeed, let's say, carbon pricing is still not really at par, and we actually don't know how to price in all the other things. Right, so we don't know yet how to find 3M for polluting the scald, for example, in a proper way. So we have all these kind of discussions on how actually environmental impact or social misbehavior really impact your business conduct, other than reputational risk at first or fines from a regulator very often, right? So any thoughts for the rest on that?
No, I think the pricing differentiation will come. And I think it's already present for certain files, maybe only for the big files, but it is happening in the sector. And again, probably regulatory-wise, new versions of Basel, it will be embedded there as well going forward. I mean, there's already much more than illusion being made. Also think about your stress testing into your SREP will also lead to more allocation of capital, so as a result, the pricing will go up.
Yeah, indeed. So the inclusion in Pillar 1 is a little bit more
further
in terms of timeline.
Yeah.
But there is indeed an expectation, but it's slightly similar to the point of, it's slightly different to the point of Jeroen, but indeed the pricing of these risks, but again from a financial institution perspective. And so the inclusion into Pillar 1 in capital ratios is indeed something that is coming also, but with the timeline more towards 25. With perhaps an expectation on also supporting factors. So today you have supporting factors on SME lending, for instance. You could have similar supporting factors for lending towards taxonomy compliant counterparties.
Yeah, sure. The aim is to impact on the price of capital for companies that have a higher score that could have access to cheaper capital, to your point.
No, exactly. But funny enough, so that's relatively easy to do for the financial industry, and that should then have an indirect effect on the cost of capital for the other industries, right? So because they don't have those direct measures as cost of capital as the regulator can put it. Yeah, quite interesting. If anyone else has questions, please go ahead, right? So let's use the mic. Yeah. Yeah, over there. Sorry. Yeah, I couldn't see you. Go ahead. Yeah.
Hello, can you hear me? Yep. Brilliant. So, thanks a lot. I'm curious to hear as well where the discussion, what your thoughts are on the social aspects of ESG. So the taxonomy has been focusing on one part of environmental, right? Yep. There's still biodiversity that's not at the moment included, and then there are all the social criteria that are planned to be included within, some form of timeline. I'm curious to hear, especially with the discussion having gone on financial institutions having to adapt their offering to customer preferences, and people also having quite strong preferences on human rights and social issues. How do you see the next coming years evolving on that, and how financial institutions can place their product and communication on that?
It's true that the supervisory expectations are, for the vast part, focused towards climate and environmental risks. There is a reference for operational and reputational risks towards social topics. And there is also, I think, a reference towards the market risk impact of investing in companies that are not following, how do you define good social governance? That's another point, but how that can influence the valuation of those assets, and so by consequence, the market risk of financial institutions. But it's true that the vast part is aimed today in the supervisory expectation to climate and environmental risks.
Exactly. And even if in the environmental taxonomy that we have today, there is a part, what is called minimum social safeguard, that it's, as the name says, it's the minimum, let's say, threshold that you should at least meet to be considered as doing business properly. But they are thinking of implementing a social taxonomy, so having exactly the same idea that they have now, but supplementing environmental objective by social objective. Unfortunately, it seems much more difficult to agree on those objectives for the entire of Europe. And so we may see it in the coming year, and I hope we will, because I think it's also an aspect that is as important as the environmental one. But it's less, let's say, advanced, that's for sure, than the sustainable one.
Yeah, one thing to add, there's also clear expectations from the clients to not only cover the E, but also cover the S. So I think so it's not only a regulatory drive, but also the clients are asking, okay, and what about social? What you see that certain banks or financial institutions are doing is, for example, reallocating their philanthropy funds and so on to more the S as well, compared to what they did before. But it's still relatively, I would say, superficial compared to the deep thinking we need around it. But therefore, I think we need again the taxonomy.
And going back to the funds, Article 8 or 9, so that are, let's say, light or green, very green. There's also the possibility to have to contributing to a social objective. But as of now, there is no way to really defining what is my social objective and how am I not harming other ones if there is not something on which everyone can base itself, and it's like a rule book once again, so that everyone can compare it. So I think it's really much needed on the market.
That's what I said, you need definitions first,
Yeah.
indeed. Yeah. And if you look at the stress test that's coming up in Q1, so after the holidays, it's purely climate.
Correct.
Yeah. So that's obviously now and clearly the focus.
Yeah, I think that's being considered as especially from a risk side, it's being considered as a more major event, and on the social side, it's much more even on the reputational side so far.
Yes, exactly.
Yeah.
Exactly.
It's a good question.
Yeah. Any other questions? Feel free. No? No? Oh, yeah, sure. Yeah, go ahead.
On the social aspect, because again, it's about pricing of the risk, right? So I think in Europe, we're used to a very stable environment, so that's also why we're focusing a lot on environmental. Your colleagues in Asia, they will have a different opinion about this, because you have so many different social laws there, different pieces, where everyone was investing in China a lot, for instance. You see also those funds being retrieved once in a while. Why is that? It's for two reasons, geopolitical and social. So those two does have an effect. Do I agree with you that there is a quantification problem? Yeah, sure. But what you see is that the sentiment that is around this and the geopolitical structure that is mostly in Asia, I must admit, but you see that in South America as well, or the interrelationship even within states in the US, it plays a lot. And you have seen that by actually investments being retrieved from where everyone was investing into their own economies. And with the way of, let's say, regions now becoming much more, they want to become more self-sufficient and so on. All these elements will also be, they want to price that in. One way or another, is the same with, you don't have the data yet, but I think we have to, there are two options. Either we are sharing, right, as every industry, because for climate risk, people say, yeah, but I don't have the data. Talk to your colleagues of the energy sector. They have climate models for ages. When I was applying for a job, Sue has offered me a job as a forecasting officer for it was wind and temperature. Imagine, back then, that's years ago. So if, of course, we would get access in the financial sector to this kind of models, this kind of data, we would actually benefit a lot. Of course, there's another thing that plays there, because data is the new gold, right? So that's probably why it is a bit stuck. But that's where, on environmental, but also on social aspects, if we would, let's say, be more collaborative across industries, we would be much faster going forward.
Yeah,
that's
good suggestion, I think.
That's what the EBA is proposing, indeed.
Okay.
Yeah. I only want to react on your first point regarding capital flows, because that alluded to that. Don't underestimate that a lot of the international investments go through European centers, being Ireland or Luxembourg, through UCITS vehicles or A vehicles, etc. and they will be captured by these taxonomies and this European regulation. So that's Europe is taking the lead, and there will be an export indirect effect of this as well for flows even going into China. And I know that certain funds, I know that from my activities on the labeling agency, that invest in China are re-looking now with ESG lenses which were not there 3 years ago, which is a good thing. Because then these Chinese companies are also being judged in an indirect way through this European taxonomy, etc.
Also something else.
But it would be better. I mean, and by the way, China is working on its own taxonomy. Yeah. Of course, that happens in the world. We don't have global regulation.
They need to use Chinese, of course.
Yeah, but
but they are basing themselves.
But they are quite also pushing also on the publications and so on. Of the listed companies in China related to ESG and so on.
They stated that they base themselves on the European one because it's the one that is available now, and there's multiple countries that are actually implementing their own taxonomy.
In a way, they're faster moving than the US for the moment, I would say.
Yeah. But you get the same effect as like with GDPR, that indeed Europe sets quite a firm standard that needs to be that will get followed across the board internationally. Correct. We have one question over there. Yeah, go ahead.
Yes, thank you. Good morning, and thank you for this first discussion. I have a question related more to the FinTech side, just to understand where your position on this ESG topic at this moment. Are you more dealing with data and possibly future modeling improvement to bring ESG into calculation purpose, especially on the Pillar 1 possibly, or stress testing under Pillar 2, for instance? Or are you also positioned into the, let's say, corporate and entity-wide framework where you could support future sustainability officer or chief sustainability officer or CSR officer to really deploy ESG within the organization in terms of tooling and in terms of FinTech point of view? Thank you.
Thanks.
More for you, I think.
We have to wrap it up after this question. Just good to know, but yeah, go ahead.
So on our side, we have, let's say, a bottom-up approach. So we approach corporate directly, and for now, because the taxonomy is quite new, and let's say the most needed, the highest need for now is to be compliant with that regulation. We support them in easily understanding what is it that I'm involved in, and what are the data that I need to produce or that I need to report on. Then the next step, once the taxonomy is more settled and that you can use it as a transition tool, is to truly help those corporates identify, okay, where are my weaknesses, where am I with respect to the taxonomy, and what can I implement in order to transition at the rate or the pace that is set by the European Commission. So on that point, our aim is to go further than being just a RegTech and to become a FinTech by helping them transition. And by doing so, you support also financial institutions that can use those data to have, let's say, prospects that are, okay, that prospect is very well aligned with the taxonomy, is moving in the right direction, even though today is maybe not on par with the taxonomy. And so that will help their own analytics in order to better, let's say, manage their sustainability strategy.
Yeah, and with Sopiad, we're really working on the front end. In the interaction, so helping a private bank or an asset manager in interacting with the end client, the investor, to get those ESG preferences better out and to come ultimately with a rating for that client rather than a performance rating a la Morningstar. We really want to have a client-centric rating. So it's more on that side of the fence, I would say.
Yeah.
And we come at the end.
Yeah, you come at the reporting part, right? Yeah.
When you need to report to the regulator.
Yeah, exactly. No, so I think that's
the circle of life.
No, I think your question is very interesting because I think indeed very often FinTech is seen as a very clear category of companies, but it actually completely isn't, because you've got data providers, you've got platforms, you've got parties that actually produce their own financial instruments, or indeed deal with the customer interaction, and all these different roles have a different role to play as well around ESG. I think because they either need to comply with regulation, or they facilitate you to comply with regulation, or they play another part in the game. But definitely interesting question to take that into account as well here. Yeah, I think we're running kind of out of time, so we might lose our at least our online audience, maybe you as well. So let's wrap it up. Any final thoughts, David?
No, I think we've discussed a lot.
Okay. David?
No, it was a great discussion. Thanks, and thanks for the questions. Looking forward to the next.
And thank you for your last question, because I think it brings all of us together and really see the how everyone can help each other to further achieve those goals.
Yeah, indeed. Thank you very much indeed. Thank you very much for joining, and thank you as well for your questions and joining us here. I hope you really enjoyed the discussion. Let's move ESG forward in finance, and looking forward to talk to all of you later on about that. So enjoy your day here.
Thank you.
Thank you.
Bye.
Yeah, go ahead.